Getting ready now to trade September week 3. We are already on monthly OPX week, and we have an Apple event on Tuesday, and we have the Fed meeting on Tuesday, Wednesday with a statement and a press conference on Wednesday. Here is what happened today, Friday, 9/11. We got our first red candle since 2009 on the daily chart for the S&P 500 on a 9/11 trading day. So that's a change in trend for certain. Here's where we opened the day. We opened strong, pretty well above where we had closed the day before. We kind of sold off into the close on Thursday, and we kind of faded and worked our way up back again to what wound up being our high of the day as we went into the European closing stretch. And from there, we sold off pretty much for the rest of the day, finally breaking down and getting all the way down for a break below the 50-day, below the two lows that we had set this week, and into this next gap below us that fills at 33.0651. In making this move on the first day that the symbol rolled over on the ES contract in December, so we have a nice big spread now between ES and S&P. We traded almost all the way down at our low to resolve that ES 32.9550 level that printed this week, mind you, with the September contract, but in doing so with the December contract, we can do a lot less damage to the S&P chart, resolving it with that contract instead. Well, they got down to about 98.25 on the ES contract, so there's still about 3.25 points more that we could test lower if we are going to have maybe one more little down day and then reverse back up again. Or are we seeing the start of like a whole second leg lower? That remains to be seen. At the end of the day, we moved up. We almost got the candle to go green again. And had we done that, we probably would have traded all the way back to the high of the day. And then that candle on the chart would have fit the pattern of what we've seen over the past 19 years since 9/11. Okay. Off of this chart here and onto the weekly. The weekly chart shows us that we have our first set of 2 red down weeks in a row. Since this little set of them here back in May, or April, I mean, but really this is really a good example. This is more akin to what we were doing back here in Q1. So that's not good. At our low on the week, we pierced down through the 10-week simple moving average. That is the same amount of time as the 50-day, but because it uses weekly closes, it's a little bit different number. So it's actually higher than the 50-day level is. So lucky for us, we did pull back and close above that. A little thinkorswim problem here. Hopefully this little message bubble goes away soon. Luckily, we did pull back up and close above this, because if we get a close below this on a weekly basis, we would most definitely be looking for a move down to the next simple moving average for us, which would be the 20-week, and that's all the way down at that 30-31 handle. It's at 31.68, 69, and rising. So if we were to break down further next week, on looking at the weekly time frame, we'd probably be looking at a move to 31.70 or so to resolve and get a good test going of the 20-week simple moving average. Where that lands in terms of levels that we are already shooting at here, that 31.70 level would be right down here in this blue box. With a close now below the halfway back for Q3, that puts us, in jeopardy of testing all the way back to the low for the quarter at 31.0117, and that's where the 200-day simple moving average is at. As of our low today, we are just shy of an 8% move off of the all-time high. That whole undershoot or overshoot of 10% comes to mind, just like it did at our all-time high, which was right at the 11% mark, 11%, and then 2 points over that. 11% would have been 35.86. We went to 35.88. If we were to go 11% off the all-time high now, that would get us down to 31.93. And if we were to overshoot that, maybe we go after that 20-week SMA at around 31.70. And maybe that's enough to satisfy this break of the Q3 halfway back. Maybe we just trade down, just get a 3100 handle to print, maybe for a couple of days, and that would get buyers to come in and get us back up again. That would all start with a gap down open below the 50-day simple moving average to start the week, and or even worse, maybe gapping down below that ES 30 to 95.50 level. That would most certainly get us rolling to the downside. However, if we open strong and get up through 33.68 early in the session, that's now the halfway back on the week we just traded. So if we open inside the range of last week, so if we open anywhere above Friday's low, we just need to trade through 33.68, and then I think we will get a very powerful move right up to the 20-day simple moving average, because that's usually what happens when we try and fend off a bearish cross. These two guys, this 10-day is going to be crossing down through the 20-day come Monday morning. So the move is going to be to run after that, and within a session or two, get above one or the other, if not both, of these simple moving averages and close above that. Okay, so that's a lot of information to throw at you. But I think it's pretty simple if you just try to remember where these simple moving averages are at. Either we're going to gap down, open below the 50-day, open flat and move up through 33.68 quickly, and then go after the 10 and the 20-day. So I think Monday's going to be an interesting day one way or the other. Have a great rest of your weekend. Hope this video helped you out. As always, good luck and good trading.